Something changes when you realize you have more years behind you than ahead of you. The way you think about money changes. The way you think about investing changes. Everything becomes clearer, simpler, more focused on what actually matters. I've been investing for over 80 years now. I bought my first stock when I was 11 years old. I've made billions of dollars. I've studied thousands of companies. I've read tens of thousands of annual reports. And after all of that, after a lifetime of learning and compounding and building, I've come to a conclusion that might surprise you. If I had to start over today, knowing what I know with the time I have left, I would only make 4 investments. Not 40, not 14, 4. And these 4 investments would give me everything I need for whatever years remain. Peace of mind, reliable income, protection against uncertainty, and the ability to leave something meaningful behind. Now, I want to be clear about something before I go further. This isn't advice for a 30-year-old with decades of compounding ahead of them. Young people should think differently about investing. They should take more risk. They should be more aggressive. They have time to recover from mistakes. But for those of us in our final chapters, the calculus is different. We don't need to maximize returns. We need to maximize certainty. We don't need to find the next Apple or Amazon. We need to make sure we don't run out of money before we run out of time. We don't need complexity. We need simplicity. Let me take you back to a conversation I had with Charlie Munger a few years before he passed. We were sitting in his living room talking about life and death and what matters. Charlie was always more philosophical than me. He read more broadly. He thought more deeply about the human condition. Charlie said something that stuck with me. He said that the purpose of investing in your final years isn't to get rich. You are already as rich as you are going to get. The purpose is to not get poor, to preserve what you built, to make sure the money lasts longer than you do, and ideally to leave something for the people and causes you care about. I've thought about that conversation many times since Charlie left us. He was right, as he usually was. The game changes when you are playing with a finite time horizon. The risks you could tolerate at 40 become intolerable at 80. The complexity you could manage at 50 becomes burdensome at 90. So I asked myself a question: if I were starting fresh today with whatever time I have left, what would I actually do? Not what would I recommend to others. What would I actually do with my own money? The answer surprised even me with its simplicity. 4 investments, just 4. And today I am going to share exactly what they are and why they're the only things I would own in my final years. Before I reveal these 4 investments, let me explain my framework, because the specific investments matter less than the principles behind choosing them. If you understand the principles, you can adapt to whatever circumstances you face. There are 4 criteria that any investment must meet to belong in a final year's portfolio. First, it must be simple enough to manage with minimal attention. As we age, our cognitive abilities change, our energy levels change, our desire to spend time on financial matters changes. An investment that requires constant monitoring and adjustment is a burden, not a blessing. I want investments I can understand completely and manage with an hour a month of attention. Second, it must provide reliable income without requiring me to sell assets. Selling assets to fund living expenses is a recipe for disaster. You are forced to sell when prices are low. You are constantly depleting your principal. You are creating tax events. A proper final year's portfolio generates enough income to live on without touching the underlying investments. Third, it must be able to withstand severe economic stress without permanent impairment. At my age, I don't have time to recover from a 50% drawdown. I need investments that will survive a depression, a financial crisis, a war, anything the world might throw at us. Not just survive, but continue generating income throughout. Fourth, it must be liquid enough to access if circumstances require medical emergencies, family needs, unexpected expenses. Life doesn't stop surprising us just because we're old. I need to be able to convert investments to cash within days if necessary, without taking a significant loss. These 4 criteria eliminate most investments. They eliminate individual stocks, which require too much monitoring and can go to zero. They eliminate real estate, which is illiquid and management intensive. They eliminate private investments, which are impossible to sell quickly. They eliminate most bonds, which have too much interest rate risk. What is left? 4 investments that meet all 4 criteria. Let me walk you through each one. The second most important investment I would make in my final years is a diversified portfolio of dividend aristocrats. These are companies that have increased their dividends for at least 25 consecutive years. Some have increased dividends for 50 years or more, through recessions, through financial crises, through wars and pandemics. They kept paying and kept increasing. This track record matters enormously. When a company has raised its dividend for 50 consecutive years, it tells you something about the culture and priorities of that organization. They view the dividend as sacred. They would rather cut other expenses, delay expansion, or take on debt than reduce the dividend. That commitment provides reliability that few other investments can match. Think about what it takes to raise a dividend for 50 years. The company has to survive and prosper through multiple economic cycles. It has to generate enough cash flow to keep increasing payments even in bad times. It has to have management that prioritizes shareholders over empire building. It has to have a business model durable enough to withstand technological change and competitive pressure. Companies that pass this test are special. Procter & Gamble, Johnson & Johnson, Coca-Cola. These businesses have been paying increasing dividends since before most people alive today were born. They'll likely still be paying increasing dividends long after we're all gone. The beauty of dividend aristocrats for a final year's portfolio is the growing income stream. If you invest $300,000 in a diversified basket of dividend aristocrats, yielding 3%, you start with $9,000 per year in income. But that income grows if dividends increase by 5% annually, which is roughly the historical average. Your income doubles in about 14 years. By year 20, you are receiving over $20,000 per year from that same initial investment. This growing income provides natural inflation protection. You don't have to sell shares to maintain your purchasing power. The dividends themselves grow faster than inflation. Your standard of living actually improves over time rather than declining. I would allocate about 20% of my final year's portfolio to dividend aristocrats, not individual stocks, because that requires too much monitoring. An index fund or ETF that tracks dividend aristocrats, set it and forget it. The income arrives in my account every quarter. The underlying holdings adjust automatically as companies enter or leave the index. The income from this allocation provides spending money. It is the portion of my portfolio that funds vacations, gifts to grandchildren, charitable donations, the extras that make life enjoyable. And because the income grows over time, I never have to worry about cutting back as I age. The most important investment I would make in my final years is short-term Treasury securities. Treasury bills, Treasury notes maturing in 1 to 2 years. The safest assets in the world, backed by the full faith and credit of the United States government. I know this sounds boring. I know you can't brag about your Treasury bills at dinner parties. I know nobody ever got rich buying T-bills. But in your final years, boring is beautiful. Boring means you sleep well at night. Boring means you don't wake up to discover your portfolio has fallen 20%. Boring means your money will be there when you need it. Right now, Treasury bills are yielding around 5%. 5% with essentially zero risk. That is remarkable for most of my career. Getting 5% required taking significant risk. You had to buy junk bonds or dividend stocks or other assets that could decline in value today. You can get 5% from the safest investment on earth. I would put 40% of my final year's portfolio in short-term treasuries on a $1.5 million portfolio. That is $600,000. At 5%, that is $30,000 per year in income. Reliable, predictable, guaranteed income that arrives no matter what happens to the stock market, the economy, or the world. This allocation serves multiple purposes. It provides base income to cover essential expenses: rent or mortgage, utilities, food, insurance, medical costs, the things you have to pay regardless of what else is happening. That income is guaranteed by the United States Treasury. It cannot be reduced. It cannot be missed. It will be there. The Treasury allocation also provides a reserve for emergencies. If unexpected expenses arise, you can let some treasuries mature and use the cash without selling other investments at potentially depressed prices. This liquidity is incredibly valuable when you don't have time to wait for markets to recover. And the Treasury allocation provides psychological stability when the stock market crashes. And it will crash eventually. That 40% of your portfolio is completely unaffected. That knowledge helps you stay calm. It helps you avoid panic selling. It helps you maintain the discipline that successful investing requires. Some people worry about inflation eroding the value of Treasury holdings, and over long periods, that is a legitimate concern. But in your final years, the time horizon is limited. If inflation averages 3% and your treasuries yield 5%, you are still earning 2% real returns. You are still maintaining purchasing power, and you are doing it with zero risk. The third investment I would make in my final years is an S&P 500 index fund. Just a simple, low-cost fund that owns the 500 largest companies in America. Vanguard or Fidelity or Schwab, it doesn't matter. They're all essentially identical. Pick one and stick with it. Now you might be thinking, wait, didn't you just say that older investors should avoid stocks? That we can't afford big drawdowns? That we need certainty? Here is the nuance. Stocks are dangerous when they're your whole portfolio. When you need to sell stocks to pay your bills, you are at the mercy of market timing. When a crash happens and you are forced to sell, you lock in losses that you can never recover. But stocks as a minority allocation, maybe 25 to 30% of your portfolio, serve a different purpose. They provide long-term growth that keeps your portfolio ahead of inflation over multi-decade periods. They provide dividends that supplement your income, and they provide optionality, the chance to benefit if markets rise substantially. The key is that you never have to sell these stocks. Your Treasury income and dividend aristocrat income cover all your expenses. The S&P 500 allocation just sits there, compounding, growing, occasionally paying dividends, but never being touched. Over my lifetime, the S&P 500 has returned about 10% annually, including dividends. Some decades have been better, some worse, but the long-term trend has been consistently upward. A 25% allocation to the S&P 500 gives you exposure to that upward trend without betting everything on it. If the market crashes 50%, your S&P allocation falls from $375,000 to $187,000. That hurts, but your treasuries are still intact. Your dividend aristocrats are still paying and probably buying more shares at lower prices. Your overall portfolio is down maybe 15 to 20%, not 50. You can survive that. You can wait for recovery. And if the market doubles over the next decade, which it has done many times in history, your S&P allocation grows from $375,000 to $750,000. That is an extra $375,000 that you can leave to your heirs or donate to charity or use for any purpose you choose. This optionality is valuable. You are not counting on the stock market. You are not depending on it, but you are positioned to benefit if good things happen. That is smart portfolio construction. The fourth investment I would make in my final years is municipal bonds from my home state, specifically general obligation bonds from highly rated issuers, cities and states with strong finances, low debt, and a history of meeting their obligations. Municipal bonds have a unique advantage. The interest they pay is exempt from federal income tax. And if they're from your home state, they're usually exempt from state income tax too. This tax-free status makes their after-tax yields very attractive, especially for investors in higher tax brackets. Let's say a municipal bond yields 3.5% tax-free for someone in the 32% federal bracket with a 5% state tax. That is equivalent to a taxable yield of about 5.4%. You are getting better after tax returns than treasuries while still maintaining high credit quality. I would allocate about 15% of my final year's portfolio to municipal bonds on a $1.5 million portfolio. That is $225,000. At 3.5% tax-free, that is about $8,000 per year in tax-free income. Municipal bonds also provide diversification. They're not perfectly correlated with treasuries or stocks or dividend aristocrats. They respond to different factors. Interest rates affect them, but so do local economic conditions and fiscal policies. Having this diversification smooths out your overall portfolio returns and reduces the chance that everything goes wrong at once. The credit quality matters enormously with municipal bonds. I would stick with bonds rated AA or higher, general obligation bonds, which are backed by the taxing power of the issuing government, rather than revenue bonds, which depend on specific projects. And I would diversify across multiple issuers rather than concentrating in any single city or agency. A municipal bond fund designed for your state can provide this diversification automatically. You get exposure to dozens or hundreds of different issuers, professional management of the portfolio, and easy liquidity if you need to sell. Let me now bring these four investments together and show you how they work as a complete portfolio for your final years. On a $1.5 million portfolio, the allocation would look like this: $600,000 in short-term treasuries, $300,000 in dividend aristocrats, $375,000 in an S&P 500 index fund, and $225,000 in municipal bonds. The income from this portfolio would be substantial. The treasuries at 5% generate $30,000. The dividend aristocrats at 3% generate $9,000. The S&P 500 at roughly 1.5% dividend yield generates about $5,600. The municipal bonds at 3.5% tax-free generate about $8,000. Total income is roughly $52,000 per year, or about $4,300 per month. That is before Social Security, before any pension, before any other income sources. Just from this investment portfolio alone, is that enough to live on? For most people, yes, especially when combined with Social Security benefits, which average around $20,000 per year for retirees. Between the portfolio income and Social Security, you are looking at over $70,000 per year in reliable income. And here's the beautiful part: you never have to sell anything. The income just arrives, treasuries mature and roll over. Dividends deposit automatically. Bond interest accrues, your principal stays intact, potentially growing through the S&P 500 allocation and the natural dividend growth of the aristocrats. This is sustainable investing for the final years, not depleting, not worrying, not watching every market tick, just collecting income and living your life. What about market crashes? What about recessions? What about all the terrible things that might happen? Let's stress test this portfolio against the worst case scenario. Another 2008 style financial crisis. In 2008, the S&P 500 fell about 50%. So your $375,000 allocation would fall to about $187,000, painful. But you are not selling it. So it is just a paper loss. Dividend aristocrats fell less, about 30%, because defensive dividend payers held up better than the overall market. Your $300,000 falls to $210,000. Treasuries actually rose in 2008 as investors fled to safety. Your $600,000 might grow to $620,000, or $630,000. Municipal bonds were mixed. Some fell sharply on credit concerns. High-quality general obligation bonds fell less. Let's assume your $225,000 falls to $200,000 AD all up. Your $1.5 million portfolio falls to about $1.2 million in the worst financial crisis since the Great Depression. That is a 20% decline. Painful. Yes, catastrophic. No, and here's the crucial point. Your income barely changed. Treasury yields were falling in 2008. So eventually your Treasury income would decline as you roll into lower yielding securities. But dividend aristocrats maintained their dividends. Johnson & Johnson kept paying. Procter & Gamble kept paying. Coca-Cola kept paying. Your dividend income stayed intact. You could ride out the entire crisis without changing your lifestyle, without panic selling at the bottom, without locking in permanent losses, just waiting patiently for recovery while collecting your income. By 2013, 5 years after the crash, your portfolio would have fully recovered, and then some. The S&P 500 more than doubled from its lows. Dividend aristocrats recovered and resumed their dividend growth. Treasuries remained stable. Municipal bonds recovered their value. That is the power of a properly constructed final year's portfolio. It bends but doesn't break. It suffers temporary setbacks but doesn't cause permanent impairment. It lets you survive anything the financial world throws at you. Now let me share some principles that tie all of this together, because the specific investments might change over time, but the principles remain constant. Principle 1 is income over growth in your final years. Reliable income matters more than capital appreciation. You need money arriving in your account to pay your bills. You can't eat unrealized gains. You can't pay the electric company with stock appreciation. Income is real in a way that paper gains are not. Principle 2 is simplicity over optimization. The optimal portfolio might generate slightly higher returns, but require constant attention and adjustment. A simple portfolio might generate slightly lower returns, but require almost no maintenance. In your final years, the simple portfolio is better. Your time and mental energy are precious. Don't waste them on marginal portfolio optimization. Principle 3 is liquidity over yield. You can often get higher yields by accepting less liquidity, private investments, long-term bonds, illiquid real estate. But in your final years, liquidity matters more than those extra yield points. You never know when you'll need cash for medical expenses, family emergencies, or other unexpected needs. Having liquid investments means you are prepared for anything. Principle 4 is durability over excitement. Exciting investments are usually exciting because they're risky. They might go up a lot, but they might also go down a lot or go to zero. In your final years, avoid excitement, seek durability. Investments that have survived for decades and will survive for decades more. Investments that your grandchildren will still be able to own long after you are gone. These principles have guided my thinking about my own portfolio for years now. As I've gotten older, I've become more conservative, more focused on income, more appreciative of simplicity, more grateful for boring, reliable investments that let me sleep well at night. I've made a lot of money in my life, more than I ever expected, more than I could ever spend. But money at my age isn't about spending. It is about security. It is about knowing that whatever happens, I'll be okay. My family will be okay. The things I care about will be taken care of. That security comes from having a portfolio that can't be destroyed, a portfolio that generates income in any environment, a portfolio that survives crashes and crises and keeps paying out year after year. The 4 investments I've shared with you today provide exactly that kind of security. Short-term treasuries for safety and income, dividend aristocrats for growing income and quality, an S&P 500 index fund for long-term growth and optionality, municipal bonds for tax-advantaged income and diversification. Together, these 4 investments create a fortress. Not an aggressive wealth building machine, not a get-rich-quick scheme, a fortress, a place of safety and security that protects everything you built over your lifetime. That is what I want for my final years. And I suspect it is what you want for yours too. Not stress, not worry, not constantly watching markets and wondering if you'll be okay. Just peace. Confidence, the knowledge that whatever happens, your financial house is in order. I've seen a lot of people make mistakes with their money in their final years. Some get too conservative too early and watch inflation eat away at their purchasing power. Some stay too aggressive and suffer devastating losses they can never recover from. Some try to get clever with complex strategies that blow up in their faces. The approach I've outlined avoids all of these mistakes. It is conservative enough to survive disaster. It is aggressive enough to keep pace with inflation. It is simple enough that anyone can implement and maintain it. It is the approach I would use myself if I were starting fresh today. At the end of the day, money is just a tool for living well, a tool for taking care of the people you love, a tool for supporting the causes you believe in, a tool for leaving the world a little better than you found it. In your final years, the best thing you can do with that tool is make sure it keeps working, make sure it doesn't break, make sure it is there when you need it, and there for the people who come after you. 4 investments, simple, reliable, durable investments. That is all it takes to achieve that goal. Everything else is just noise. Let me share something else that I've learned about investing in the final years, something that took me decades to fully appreciate. The relationship between money and time changes as you age, and understanding that change is crucial to making good decisions. When you are young, you have more time than money. You can work harder. You can take risks and recover from failures. You can compound small amounts into large amounts over decades. Time is your greatest asset, and you should leverage it aggressively. When you are old, you have more money than time. You've already done the compounding. You've already built the wealth. What you can't do is add more years. Every year that passes is a larger percentage of your remaining life. Time becomes the scarce resource, and money becomes the tool for making that time as good as possible. This shift changes everything about how you should think about investing. A young person should ask, how can I maximize my long-term wealth? An older person should ask, how can I maximize my quality of life with the time I have left? These are different questions with different answers. Maximizing long-term wealth means taking risks, accepting volatility, and prioritizing growth over income. Maximizing quality of life means reducing risks, accepting lower returns, and prioritizing stability over growth. The 4 investments I've outlined are designed for the second question. They're designed to provide the highest quality of life for someone in their final years. Not the highest returns, not the most impressive portfolio performance, the best life. What does the best life look like financially? It looks like never worrying about money. It looks like knowing your bills will be paid no matter what. It looks like having enough to help your family when they need it. It looks like being able to give generously to causes you care about. It looks like leaving a meaningful inheritance rather than depleting your assets. This portfolio delivers all of that. The income covers your expenses with a comfortable margin. The principal remains intact for emergencies and inheritance. The simplicity means you don't spend your final years stressed about financial decisions. The durability means you don't have to fear market crashes or economic disasters. I think about my own mortality more often now than I used to. When you are 94 years old, it is impossible not to. The calendar becomes very real. Every year is a gift that, won't keep coming forever. This awareness has clarified my thinking enormously. Things that seemed important when I was younger don't seem important anymore. Things that seemed trivial have revealed themselves as essential money. It turns out matters less than I thought it did, but having enough money to not worry about it matters more than I realized. That is the paradox of wealth in old age. Money itself becomes less important, but the security that money provides becomes more important. You don't need more money to buy more things. You need enough money to buy peace of mind. The 4 investments I've described are investments in peace of mind. They're not optimized for returns. They're not designed to impress anyone. They're designed to let you live your final years without financial stress. And that is worth more than any amount of extra returns. I've also learned that the best investment advice for your final years is often the advice you are least likely to follow. People know they should simplify their portfolios. They know they should reduce risk. They know they should focus on income. But knowing and doing are different things. There is an emotional attachment to investments, especially investments you've held for decades, especially investments that have done well for you. Selling them feels like betraying an old friend. Even when selling is the right thing to do, it is hard. I've experienced this myself. I've held stocks for so long that selling them felt wrong, even when the investment case no longer made sense. I've kept positions I should have sold because I couldn't bear to let go. We all have these tendencies, but in your final years, you have to overcome these tendencies. You have to be ruthless about simplifying. You have to be willing to sell old positions and move to more appropriate investments. You have to put your well-being above your emotional attachments. The 4 investment portfolio I've described requires letting go of complexity. It requires accepting that you don't need 20 or 30 different holdings. It requires trusting that simple can be better than complicated. For many people, this letting go is the hardest part. If you are struggling with this, ask yourself a question. If you died tomorrow, would your spouse or children be able to manage your current portfolio? If the answer is no, your portfolio is too complicated. Simplify it now, while you are still able, rather than leaving a mess for your family to deal with. My own estate planning has focused heavily on simplification. I want my family to inherit assets they can understand and manage without my guidance. Treasury bonds, index funds, simple, liquid, straightforward investments. Nothing that requires special expertise or constant attention. This is an act of love as much as an act of financial planning. You are making your family's lives easier during an already difficult time. You are ensuring that your legacy isn't complicated by confusing investment portfolios. You are giving them the gift of simplicity along with the gift of wealth. I want to address one more thing before I close. The question of legacy. What do you want to leave behind? Not just financially, but in terms of values and wisdom and lessons learned. My approach to investing in my final years reflects my values. Simplicity over complexity, durability over excitement, prudence over greed. These are values I've developed over a lifetime, and they're values I hope to pass on to my family and to anyone who has listened to me over the years. The 4 investments I've described embody these values. They're simple, they're durable, they're prudent, they won't make you fabulously wealthy, but they also won't let you down. They won't embarrass you or your family. They'll do exactly what they're supposed to do year after year for as long as you need them. There is something beautiful about investments like this, something honest and trustworthy. You know what you own, you know why you own it, you know what to expect. There are no surprises, no gimmicks, no hidden risks. Just solid, reliable, boring investments doing their job in a world full of financial complexity and innovation and excitement. Boring is underrated. Boring means predictable. Boring means reliable. Boring means you can focus your attention on the things that actually matter in your final years. Family, friends, experiences, meaning, rather than worrying about your portfolio. I've lived an extraordinarily fortunate life. I've had the opportunity to do work I love for over 8 decades. I've been surrounded by brilliant partners and loyal colleagues. I've been able to provide for my family and support causes I believe in. I've had more success than I ever imagined possible when I bought those first shares of City Service Preferred at 11 years old. And after all of that, after all the complexity and the deals and the billions of dollars, the wisdom I've arrived at is remarkably simple. Own good things, don't overpay, be patient, and as you get older, prioritize security over growth. The 4 investments I've shared with you today represent that wisdom in its most practical form. Short-term treasuries for absolute safety, dividend aristocrats for reliable growing income, an S&P 500 index fund for long-term growth, municipal bonds for tax-advantaged income. That is it. That is what I would own in my final years. Nothing fancy, nothing exciting, just the building blocks of financial security arranged in a way that lets you live well and sleep well and leave well. I hope this has been helpful. I hope it has given you a framework for thinking about your own final year's portfolio. And I hope it has convinced you that simple can be better than complicated, especially when the stakes are highest. The years we have left are precious. Don't spend them worrying about money. Don't spend them managing complicated portfolios. Don't spend them chasing returns you don't need. Spend them living. Spend them with people you love. Spend them doing things that matter. The 4 investments I've described will take care of the money part. They'll generate income. They'll preserve capital. They'll survive whatever the world throws at them. You can trust them to do their job. And that trust, that confidence, that peace of mind is the greatest return any investment can provide.